Welcome back to another episode of Multifamily AP 360. And today's our guest is Gideon Pfeffer from GSH Group. Welcome, Gideon.
Yeah, thank you, Ram. It's so nice to be here.
Thank you very much. A little bit about Gideon. Gideon has been involved in opportunistic real estate investing for more than a decade. Gideon is responsible for strategic partnership initiatives and ventures, equity and debt opportunities, overseeing investment performance and approving decisions on investments and acquisitions. He also oversees daily operations under Gideon's leadership and direction. Over the past 5 years, the GSH Group has raised and placed over 300 million of equity and assembled a portfolio of over 7,000 apartment units in 5 states worth over $1 billion. So with that, Gideon, you want to add anything to your background?
Thank you. I've been focused primarily on multifamily and multifamily development since 2017. So about 7 coming on 8 years now. Before that, I was a high volume single family aggregator. And I know a lot of us who are getting into multifamily or want to get into multifamily maybe start with real estate investing on the single family side. So I have that.
Sure, thank you. So how did you get into real estate?
So I actually started in residential mortgage brokerage. So if somebody wanted to buy a house to live in, I was somebody who would provide a mortgage for them. And I got into that business right after college in 2002. And that was a good time. Interest rates were coming down. They're probably around the same levels that they are today. Right? I remember refinancing folks into lower rate mortgage, and the new mortgage rate was like 7%. And people were thrilled to get that 7% mortgage. I didn't know any better because I was just a kid right out of college. What I was able to do is network and meet people in the real estate world and become friends with somebody who encouraged me to buy a house with him, an investment property. And we bought it, we fixed it up, and instead of flipping it and selling it to a homeowner, we actually put a renter in and then sold it as a turnkey investment property to an investor. And that worked out well. So we took the proceeds and bought more homes. And eventually, within a couple of years, we had an operation where we were providing turnkey rental properties to investors at a high volume. We were probably doing anywhere from 100 to 200 houses a year.
Phenomenal. So what made you move from single family to multifamily?
I think that after a period of time, I bought, fixed up, sold, or managed over 3,000 units, and, kind of call it between 2007 and 2015. And it was all a trader business for me, meaning, I was either earning fees or I was buying and selling the home within a year period. So I wasn't benefiting from capital gains. I wasn't benefiting from the passive income from owning the real estate. I was always just selling the real estate. And so when my partnership in that venture ran its course, and I did another kind of large joint venture partnership where we did a bunch of single family homes. And after that, my wife and I kind of took a break. It was 2016, and envisioned, what do we want the next chapter of our lives to look like, both personally and professionally. And we brainstormed, how can we take the lessons that we've learned over the course of the last 10 years and apply them to our next venture. And some of those key factors that I just mentioned were important to us, right? How do we make money up front? How do we make passive income? How do we benefit from capital growth and appreciation? And maybe even take advantage of some of the tax advantages of owning real estate, like depreciation and capital gains when sold. So we realized that multifamily was probably the best place for us to focus our efforts. At the time, call it 2016, 2017, there was institutional interest in single family, but it was still very early. It was still very new. It was probably just 3 to 4 years mature. And so I felt that it would be easier for me to organize capital and raise equity around multifamily than, large single family projects. So that's why I've transitioned into multifamily.
Got it. Awesome. Thank you very much. So from 2016 to 2024, almost like 7 to 8 years, over 7,000 plus apartment units, and also over 1 billion, acquisition under management,
Yeah.
or asset under management. So what's your unique approach?
I think that it starts with, there's a unique business approach, and then there's a unique personal approach, right? And I think that for me, communication, authenticity, transparency, has been really an important secret, well, maybe not a secret, but a big piece of the recipe for success. People are going to invest with you, invest with me. They want to believe, that they can trust me, right? So ongoing communication, whether it's good or bad communication, is probably the biggest key to gaining investor trust and keeping it. On the professional side, with the business growing the GSH Group, initially we focused primarily on what we called workforce housing. And that's kind of your B class, maybe older vintage property. We started in our backyard in Michigan and started building a portfolio and to provide, a safe, clean, and affordably priced place to live for, the average person, right? The person who maybe, just can't quite afford to buy a home or they're a renter by choice, right? But maybe they can't afford, a class A property. And, we were value add investors. So we would buy a property that maybe had a little bit of wear and tear or was a little bit tired from an aesthetic perspective, and we would enhance it. We have a construction company that allows us to be vertically integrated into our business model. And so we would go in and we would improve and elevate the exterior and common areas of a property as well as the interior units. Maybe charge a little bit more in rent, but just really elevate the property from a look, feel, and amenity perspective and make it a place where folks wanted to live. I know that's not a completely uncommon business model, but it was ours. And then in 2020, when the COVID pandemic happened, the term essential worker was coined, right? And the essential worker really was who we had been renting to all along in this B class workforce housing model. And so we took that term and ran with that as well, providing safe, clean, and affordably priced places to live for our, country's essential workers.
Awesome. Thank you very much. So you guys are like in-house property management also?
So we haven't done in-house property management on a large scale. We do have a property management company, and we managed every asset that we owned that was less than 100 units. We self-managed. We eventually exited out of those smaller units, so we're primarily third-party management at this time, which comes with its own lessons and challenges. But maybe one day when we're a little bit bigger, right now with GSH, we purchased about 7,800 units. Right now, we're just below 6,000 units because of some exits. So I really feel like self-management is important. And also, I think we probably need to be a little bit bigger to do it right.
Got it. Yeah, thank you very much. So at what time you guys integrated that construction management also? So, and what is the reason behind it?
We started GSH in 2017. We created the construction company, Multifamily Commercial Construction, or MFCC, in 2019. And we did it so we noticed that with the third-party property managers, sometimes capital improvements were taking a little bit longer to get done than we would prefer, maybe starting later than we would prefer. And we didn't have as much control also on the cost. So in my single family career, I had owned a construction company to do all of the renovation work on those homes. So we decided to do the same thing. And so 2019, we created that infrastructure. And again, like I mentioned earlier, really to be vertically integrated into our business model on every property, right? Because most of the properties we purchased had some level of capital expenditures, CapEx work to be done. And so we could control that. We could control the timing and the cost.
Got it. Yeah, thank you. So how exactly like from cost point of view or turnover time point of how exactly like improved or no, what are your typical timeline for turnover?
I mean, I think that what we've been able to do is take larger capital projects that might not start until like 4 to 6 months after acquisition and start them more immediately, within the first 30 to 60 days of takeover. That's important from a resident perspective. So, when there's a new ownership change, often there's a new management company in there, and to give residents confidence that new ownership values them and values the property and is going to do what they're saying they're going to do, getting going and spending money quickly is important to prove that. From a unit perspective, we were able to take unit turns down from maybe upwards of 30 days down to 10 days, and yeah, just become much more efficient in that process.
Yeah, definitely. That's almost reducing 20 days. That's really, awesome.
Yeah, because when you think about it, if it takes 30 days to renovate or turn a unit, it's going to take at least another 30 days to lease it out, probably more like 45 to 60. So you've lost 25% of revenue on that unit for the year.
Yeah,
The quicker you can get in and turn it and leased,
yeah,
the better for the bottom line.
sure, sure, awesome. So what is your typical portfolio looks like? What markets and what size of properties, and also, what class of properties, what markets?
Yeah, I mean, primarily we have our vintage workforce kind of B class housing. So we're in 6 states. We're in Michigan, Indiana, Ohio, Maryland, Massachusetts, and Florida. We're very heavy in Michigan in the Midwest because that's where we're located. We understand it. And through the course of the years I mentioned, 2017 to now, the Midwest up until probably about 2021 wasn't heavily favored from an institutional buyer perspective. So we were able to kind of be a bigger fish in this pond out here. And we like the market demographics, the slow and steady rental pool. There's not a ton of new supply coming online, so fundamentals of occupancy and collections are relatively sound. And so we've had success in the Midwest. We were somewhat location agnostic. My family and I spent a lot of time in Florida. We have a home there. And so it was kind of like anywhere between Michigan and Florida. And we tried and offered competitively on properties in Tennessee, in the Carolinas, in Georgia, kind of throughout the eastern part of the United States, Texas as well. We just weren't competitive. We just didn't actually weren't able to purchase properties there. So we're somewhat location agnostic, like I said, but we kind of fell in opportunities in those markets that I mentioned.
Yeah, got it. So we are doing like May of 2024, and Midwest is really doing well from, rent growth point of view, or, overall, right? So yeah, that's
Sure.
good. You're in good markets. So, and from debt point of view, share me like, what kind of debts you're using for all your portfolio.
From the beginning, we used a combination of bridge financing for larger construction projects as well as fixed rate agency financing. We primarily purchased with fixed rate debt when we could. And there were certain projects early on that we put on bridge and then refinanced kind of in a good timing perspective. We were in some bridge from 2018 and 19 in 2020 when interest rates went really low. And so we got out of all of that bridge and got it fixed into long-term fixed rate, low interest rate loans. We did acquire quite a few communities in 2021, and kind of towards the second half of 2021, we purchased a handful of properties with bridge debt. Looking back, in hindsight, the market was very frothy. There was conversations about interest rates going up, but when we followed the Fed guidance and the forward curves for SOFR and LIBOR, we factored in what those interest rate increases would be based on the guidance that was given. But not anticipating a 500 basis point increase. So we did get caught in some bridge loans. Luckily, because of our size, infrastructure, and relationships with our lenders, we've recently been able to modify those loans and extend out for about 3 years, get some relief on interest rate, which will help us, kind of finish off the business plans of those properties and eventually refinance or sell out of them. So that was a big undertaking. That was definitely a good lesson, an unfortunate lesson maybe, to learn about looking at indicators besides just what the Fed is saying. What's the conversation on the street? How easy is it to procure debt and equity? I think that in 2021 it was very, very easy to procure debt and equity. And when that's happening, maybe the market's getting a bit frothy, right? So in the future, I think maybe when that's happening, our antennas will be up a little bit more and we'll be a little bit more reserved either in our acquisitions or the type of debt that we get or the debt levels.
Yeah, thank you. So any challenges like when you're doing loan modifications?
The biggest challenge I mean, there's definitely challenges, right? So you're working with the lender in good faith, right? And we're trying to look at each other as partners because neither of us want the properties to go into foreclosure, but we're both representing our own interests, right? So there's a negotiation there that is challenging. And depending on how your loans are structured, I was in quote unquote non-recourse loans, but there were guarantee provisions in there, like rebalancing tests and springing interest reserves and some of these things where I did have recourse risk. And so that was a very stressful part of the negotiation where I had to balance. I couldn't just walk up to the lender and say, give me what I need, or you can have the keys back. I had to balance the personal financial risk as well. And so it was a very stressful time period. We started conversations with our lender in late October of 2023, last year, and we didn't close the modifications till the end of March. So there was a good 5 months of negotiation and some sleepless nights.
So what's your exit plan for all these multifamily properties?
And I'd be remiss if I didn't actually add one more thing to that last piece, in terms of challenges. I think that, I kind of went to the personal side, and at the same time, I'm a syndicator, right? So my partners and I have a significant amount of our own money in these deals, but we also are representing hundreds of investors, right? And the prospect of losing their money was more of a weight on my head and my heart than losing my own, and something that I never want to have to deal with. But that the reality of real estate and market cycles is that there's some things that are in my control and there's some things that are outside of my control. But balancing being the right type of steward and fiduciary to our investors, while also navigating the realities of the property, the market, and our own financial risk. It was a challenge, but we were able to overcome and get through it.
Yeah, that's a really, really good point from an investor's perspective. Thank
Yeah.
you for sharing that. So what's your exit plan for, your portfolio?
So we've noticed that in our vintage B class properties, that rent growth has not always outpaced expense growth right now. And so we're evaluating our older properties that have been great properties for us, that are in fixed rate debt, and kicking off good returns, and we're paying preferred returns and all that. There's a value right now to selling a property with fixed rate debt, with low interest fixed rate debt. There's a premium on those. And so we're being strategic throughout our portfolio on which maybe should we exit, because our expenses are higher than pro forma, and we can get our investors a really great return. And maybe the cash flow distributions that they're getting are not going to last into long-term perpetuity because of the older nature of the properties and the fact that they're going to need, future significant capital work to them. So we're paring down our portfolio a bit from that perspective, selling properties that may be performing right now, but there's a value to sell them because of the low interest debt. Obviously, we work through the bridge loans, and we need to stabilize those and refinance out of that. We've got about 36 months to do it. We're looking for opportunity. We're always looking for opportunity. It's a little bit harder today based on where interest rates are. There's still, what we see is a pretty large disparity from where folks want to sell properties and where the interest rate financing is. And in some cases, in the higher growth markets, people are looking at negative leverage, right? Where, you actually are betting on the properties improving on the back end, but there's no immediate cash flow. If anything, there's negative cash flow. And we're not entirely comfortable with that type of an investment. So we're being patient, and we're, turning over a lot of stones to try and find the right opportunity. And through our construction company, we're also looking for development opportunities. So we're delivering a 90-unit new construction property here in Michigan, in Lansing, which is the capital of Michigan and where Michigan State University is. We also are doing kind of a cool adaptive reuse project in a very affluent community here in Michigan called Grosse Pointe, where we purchased the original schoolhouse that was being used as the administration building for the school district, and we're converting it into luxury apartments and building some townhouses on the same land. So getting creative, to keep our team busy, and waiting for the next round of opportunities whenever they present themselves.
So what are some lessons learned from building like over 1 billion portfolio?
Lessons that I've learned along the way are, with property management, you asked about property management earlier, right? Do we self-manage? And if we're not self-managing, we need to be very involved with the on-site property management team from the day, even before the day that we purchased the property. The property manager, whether it's the one that's already at the property or a new one we're bringing in, needs to be fully in tune and in line with what the business plan is, and share the same values that we have. And I can't just sit back and think that the property manager is going to handle things the way that I would, right? We have to be involved on a weekly, if not daily basis with them. So I think that that's number one, making sure that, you're integrated or we're integrated into our properties, vertically, one way or the other through direct contact with management or construction. Another lesson I mentioned earlier, like there was a great real estate run from, 2012 through 2022, right? That's 10 years of growth. And towards the end, things were very frothy. A lot of new people were getting into the market, very easy to raise capital. And there was talk about inflation and interest rates going up. And I think that in hindsight, if I could do something differently, I probably would have exited some more of my properties than when interest rates were low and prices were high, taken some chips off the table, and maybe not have been so aggressive on continued acquisitions. Or if I was acquiring, I probably would have put lower debt levels on. So I don't think that the issues that I have, I don't think I'm unique, right, with the issues that I had because of that, but, lesson learned. And hopefully I can remember that in the next cycle.
Yeah, absolutely. Great points. Thank you. So what's your company's plan for next, 12 to 24 months?
So we're looking at opportunities for development, adaptive reuse, integrating our platform for being able to organize capital and deploy it towards interesting investments, integrating that with our construction company from a design build perspective, and maybe do some interesting deals like the school building that I mentioned, focusing a little bit more on construction than existing assets. Our most recent property we purchased was already almost a year ago now. We purchased a brand new Class A property, 320 units in Grand Rapids, Michigan, which is one of the best markets in the Midwest. Buying an A-class asset was something that we hadn't done up until this point and are probably looking to do more of that, right? We believe that there's probably a disconnect also with developers who have been building to an expected sale cap that doesn't exist anymore. So a big focus on what we're trying to harvest are opportunities to buy newly constructed properties from developers who maybe need to exit in some strategic way.
Yeah, awesome. Thank you. And any habits that are helping you to be successful?
A big thing for myself and for my wife is balance. So I have a personality and I'm driven. I'm driven to grow and to do more. And, I think that's a blessing and a curse. So having balance, knowing that I can't get everything done in one day and having balance throughout the day to take care of myself, to take care of my family, to nurture the relationships with my children and my wife, taking time in the morning to wake up and center myself. I do journaling, I do meditation. That allows me to fill my cup up and then I can, give the rest of the day to my team. So, I think the biggest habits for me for success is not putting out all of my time and effort towards the material success, but, being successful in a well-rounded way.
Perfect. So any personal learning, any one learning that played major role in your success?
Listen to my wife. I'm joking, but my wife she's the CEO of our company. She's got a master's in organizational development, and I'm like a say yes and figure out how kind of guy.
Yeah.
And she's a measure twice, cut once kind of person. And so finding a balance between those two things, but realizing sometimes when I jump in with 2 feet without as much thought behind the process,
Yeah.
actually ends up stifling the growth. So I think that we built a lot of companies at this point and had a lot of success, but also had challenges throughout that. And I think that personal learning, that, my way is great and I'm good at creating and building, but it's also good to, due diligence is always good.
Yeah, absolutely. Totally agree on that. Upfront due diligence will save a lot of time, energy, and
Yes.
money, right?
Yes.
So awesome. Any one book that impacted your life?
Yeah, I know it's kind of towards the end of the show, but I battled 11 years ago, I battled with drinking too much. And I read a book called Alcoholics Anonymous, and it's a big blue book. And that had a profound that book and that program had a profound effect in my personal life as well as my business life and the success, because how I was kind of living was not conducive to long-term success. And 11 years later, things look a lot better and a lot different because of it.
Awesome. Thank you. So how can listeners can connect with you, Gideon?
You can go to our website, which is www.gshrealestate.com, and learn more about us, or you could reach out to me directly if you're interested in our platform, learning more about how I scaled my single family business or transitioned over to multifamily and scaled multifamily. Shoot me an email at Gideon@gshrealestate.com. That's Gideon at gshrealestate.com. I'd love to connect with you. Yeah.
Yeah, sure. And thank you very much, Gideon. Thank you for sharing your single family real estate journeys from single family to multi-family, and also lessons learned, and also your habits and other stuff. Thank you very much.
Thank you, Rama.